Time for the market report. The rally continues for row crops.
That's right, Mike. And livestock dropping. We'll look into the details of both. But first, the numbers. What were the week's biggest gains and losses? And then some recent USDA reports telling us what the livestock sector looks like right now. And finally, market analyst Dan Hueber gives us his take on the row crop rally. So, markets closed the week still splitting, row crops up, livestock down. Let's take a look. The week's biggest gain, sugar up about 3/4 cent, a near 4% increase from the previous week. The week's biggest loss, lean hogs, down nearly 5 cents, and over 5.25% decrease from the previous week. Several USDA reports dropped recently, giving us the monthly update on cattle, milk, and poultry. In short, cattle on feed down 1%, milk production up slightly, and poultry slaughter up 1%. Here's Bella Bingham with the details.
In this month's Cattle on Feed report, cattle and calves on feed down 1% from February last year. Placements in feedlots January this year 2% higher than last year, while marketings of fed cattle 1% higher than January last year. Other disappearance 26% lower than January last year. In the milk production report, January 2025 production up slightly from last year. Production per cow 8 pounds below last year, and number of milk cows on farms in 24 major milk-producing states up 54,000 head. In the poultry slaughter report, certified wholesome poultry up 1% from January last year. Total live weight also up 1%. Young chickens inspected up 2% and mature chickens up 3%. Turkey inspections down 5% from last year, while ducks down 14%. Young chickens slaughtered up 1% from last year, along with turkeys, also up 1%. Dr. Josh Maples commented on the Cattle on Feed report, stating, February placements are likely to be impacted by the lingering impacts of the Mexico cattle import ban. A regional look at the data implies the impact of the Mexico import ban on January placements. January 2025 placements of cattle into feedlots in Texas were 50,000 head lower than a year ago, which is a 14.5% decrease. This was offset by a 60,000 head increase in Kansas and a 30,000 head increase in Nebraska during January. The largest increase in placements was in the 700 to 799 pound weight range, which were up 30,000 head from a year ago. Placements were up across all weight classes in Nebraska and Kansas, and lower across all weight classes in Texas. Placements of cattle into Texas feedlots weighing less than 699 pounds were down 35,000 head during January compared to a year ago.
In our row report this week, we look at what's causing the constant price rises. Corn and wheat higher than this time last year, but soybeans and cotton lower. What's been causing this rally? Market analyst Dan Hueber gives us his take.
The stagnation, I think we've enjoyed really a very nice rally in these markets for the last 7-8 weeks, really since the middle of December. And as all things, we've adjusted for some adjustments in lower production numbers of the corn, more specifically a little bit of kickback in demand. But here again, that's what the function of the market. We should adjust for those changes within the supply-demand picture, and then you need something new to make it go any further, and I think we've probably kind of exhausted that story at this point. Of course, in wheat, when it comes to winter kill, nobody really knows until we, of course, get into the spring and summer months. Where you've got a kind of a dichotomy going in the wheat right now is when you look domestically, there's certainly nothing bullish. When ending stocks continue to grow, I think we're going to be the highest we've been in probably the last 5 years, somewhere in that neck of the woods. But then if you look over at the global stocks continue to contract. So you've got kind of a push and pull situation there. So, if other problems do develop with some, let's say, winter kill in Russia, Ukraine, maybe even in some of the European nations, then you might be able to build on that story a little bit. But I think at this point in time, until we see something more concrete, it's going to be difficult to extend prices above and beyond where they've been already. There's actually a number of targets that were hit this week. When you look at some of the longer-term charts in December corn, on just the December weekly, we made some good retracements, tested some highs of a year ago. So as much as anything, there are areas to watch. There's nothing magic that says we have to stop at those zones. But that said, next week we're going to hear some acreage estimates. Granted, they're going to be statistical estimates that are going to be generated by a computer. But I think for all intents and purposes, most people feel we're going to see extra corn acreage out there next year. So unless you can back that up with a weather issue, higher acreage, ample supply, not a burdensome supply, but an ample supply of corn, then how do you really justify taking prices higher? Positive fundamental news is hard to come by. There's fundamental news out there. Export sales, we did bounce back a little bit here this last week, but sales have really drifted off. We know the South American harvest is going to just continue to pick up pace. They're going to take a larger and larger share of the current business that's happening. Yes, the report that came out last week, was that last week? Or, as far as the supply demand, it really, you could say it was a little bit positive of the beans, that the carryout was not as high as expected, but it's still growing each year. So it's just not as overwhelming as we once thought it was. So.
And that's it for a deeper look into the markets. The row crop rally continues. Time will tell when it decides to slow down.